Hi, welcome to your next edition of Highlights. And today we're going to be looking at uh, using the longer term trend to set up new trades. The theory, and this is what we use in our trading all the time, is looking at a longer term trend and set up a new trade in the direction of the longer term trade, because usually those moves will have the biggest bang for the buck. It's fine to go against the longer term trade, but in that scenario we would just be looking for a lot smaller profit potential. So what this means is for bullish signals like hammers or shooting stars or morning stars, or the more advanced ones like separating lines and bull sash patterns, we would be looking to be a little bit more aggressively long, buying on short-term dips if the longer-term trend was up, as opposed to, buying aggressively if the longer-term trend is down. If you do buy within a longer-term downtrend, we would just be looking for a little bit of profit potential. And there are a few ways to define trends. Okay, one way is just looking at higher highs and higher lows. For example, if you have a bull channel, you're in a bull trend. You could look at charts of a higher degree. So, for example, if you're looking at a daily chart, you may look at a weekly chart. Or if you're looking at an intraday chart, you may be looking at a daily chart to get a longer-term sense of your trend. We could use moving averages. A very popular one is the 200-day moving average. So if the stock is above a 200-day moving average, we'll say that the trend is up. And another way to use it, and one we focus on in our education and our trading also, is using golden and dead crosses. These are Japanese terms for moving average crossover. So you have two moving averages. When the shorter term moving average crosses over the longer term moving average, it's called a golden cross. And when the shorter term moving average crosses under the longer term moving average, it's called the dead cross. So for example, and there's actually a slide we have from one of my advanced DVD workshops. So here we have a golden cross, the shorter term moving average, the 20-period moving average. And we like looking at 20 and 50 period simple moving averages. As a general rule, there are exceptions to this. So here we have the 20-period moving average in the blue line and the 50-period moving average in the dotted line. And the 20 is over the 50, so we have a golden cross. So at the green arrow, we have a hammer, okay, coming after a short-term downtrend, but that hammer emerges within the context of a longer-term uptrend. So we would be more aggressive on that particular trade because you're getting a bullish candlestick signal within the context of a longer-term bull trend. Now, be sure to be on the lookout for a special email over the next day or two inviting you to be on the early alert list to get information about my only 2 live seminars that I'm doing this year. So look forward to joining you at our next highlights.